Nomos is now challenging FMI.
Good morning, ladies and gentlemen. Welcome to the fourth session of FNA's Financial Market Infrastructures broadcast. We're happy you're joining us today. I'm Carlos Leon, and I'm your host in this series of FMI's broadcast. We'll give the audience a few minutes to log in and join. In the meantime, let me do some housekeeping. The FMI's broadcast follows a 60-minute format in which our guests will provide expert insight into the latest developments and innovations influencing the industry today. You can use the Q&A widget below to ask your questions, and the speakers will aim to answer as many as they can during the 10-minute Q&A part. Please do not forget that Chatham House rules apply. So first, some words about FNA. FNA is a leader in advanced network analytics and simulation. FNA software is used to uncover hidden connections and anomalies in large, complex datasets, to predict the impact of stress events, and to optimally configure financial systems and infrastructures. FNA is trusted by the world's largest central banks, government authorities, commercial banks, and financial infrastructures, such as the ones which are portrayed in these icons to your right. So regarding the FMIs, FNA has an advanced network analytics and simulation set of solutions for FMIs, which have like two big sections, the building and the operating and overseeing. By doing so, we are covering several steps of the FMI lifecycle, which are the design, the validation, and the go live of the FMIs, which are followed by the monitoring, stress testing, and optimization of FMIs. With these 6 steps and 2 sections that we have designed, the aim is to reduce the design and validation costs while increasing the effectiveness of the design and validation of FMIs, increasing also the effectiveness of attaining regulatory approval and member engagement. Third, to improve regulatory compliance and oversight, and managing the risks that are normal to FMI lifecycle. And finally, optimizing the system design and the parameters to reduce risk and increasing efficiency in the operation of FMIs. So today we have two speakers, Claudio Ceresani and Phil Mochan from DGT Solutions and Nomos Digital. But before making these brief introductions, let me introduce the subject that we're going to deal with today. Cross-border payments have always been in the spotlight. They have been criticized for being slow and costly, unable to cope with the demands for efficient payments among individuals, firms, and financial institutions from different jurisdictions. Challenger financial market infrastructures are trying to solve this long-lived demand for efficient cross-border payments. New technologies, along with access to flexible and affordable computing services, have encouraged the development of solutions that aim at fulfilling the demand for better retail and wholesale cross-border payments. In this session of the FMI broadcast, we're going to discuss how challenger FMIs are contributing to solving the cross-border payments conundrum. Together with Phil and Claudia, we will discuss to what extent challenger FMIs have been, are, and will be able to influence the cross-border ecosystem. So let me introduce Claudio first. Claudio has over 30 years of extensive management and global business experience in payment systems, including real-time payments, high-value and retail payments processing, central bank digital currencies, and clearing and settlement of securities and equities. Claudio has dealt with more than 50 central banks and market infrastructures, giving businesses and technical advice, and has, in addition, been personally involved in shaping the transformation of more than 20 central banks' payment system strategies. Claudio founded DGT Solutions to enable institutions to accomplish complex transformation initiatives. He holds an MBA and a university degree in electronic engineering. Thank you, Claudio, for joining us. Phil, in the last decade or more, has established and led a retail payment business and a digital post-trade business, becoming a thought leader in digitalization of capital market infrastructure. In 2021, he established Nomos, bringing an innovative deliverable solution to the problems of cross-border payments through a partnership with central banks and correspondent banks by addressing the core problems of adaptability, settlement, and liquidity. He has qualifications in computer engineering, marketing, and corporate finance. He's a member of the Chartered Institute of Marketing and a fellow of the Royal Society of Arts. So Phil, thank you very much for joining us. Claudio, thank you very much for joining us.
Thank you.
So before we start, can you tell us a little bit about what DGT Solutions and Nomos Digital do in the FMI's cross-border payment space?
Yes, thank you, Carlos, for the introduction. DGT Solution started in 2018, and actually the aim of this small consultancy company is to help financial market infrastructure in the transformation process. We are very, very focused on national transformation project, mainly payment systems. So we are very, very focused on RTGS, system payment system, central bank digital currency, everything that is a nationwide payment system transformation. And we were involved quite in many countries. Actually, between all of my partners, we were involved in the transformation of more than 20 national payment system. In the recent, the most important, we were involved in UK in the RTGS transformation project that is actually still ongoing. In Saudi Eastern payment system and the Central Bank of UAE Eastern payment system. We are also involved in several with the World Bank as a consultant to the World Bank in several technical assistance projects around the world, helping specifically emerging central banks to, let's say, to shape their new payment system. Actually, most of the project currently are instant payments and mobile payments. This is what we are involved recently.
Thank you, Claudio. Phil.
Thank you again, Carlos. Nomos is a much younger business. We intend to be a wholesale challenger FMI looking to go live in 2025 through partnerships with both central banks and correspondents. We've come up with a very much a new approach that seeks to facilitate a very simple transition from the existing models to something that can both reduce costs by upwards of 40% and lead to a real-time payment system cross-border. In that we mean sub 1 minute. And we do that by delivering multilateral settlement and changes in the way of liquidity provisioning and delivering capital efficiency. Thank you.
Thank you, Phil. Thank you, Claudia. So let's start with the formal questions. So the first one, which is intended for you both, is can you give us a brief portrait of the current state of affairs regarding how challenger FMIs are trailblazing the cross-border payments industry? Let's start with Claudio.
Okay, thank you, Carlos, for the question. It's a good start. Okay, I just want to be a little bit provocative, just starting that. I think that the first time I heard some, let's say, some new challenger FMI saying that we are sort out the cross-border issues was more than 10 years ago. Actually, we are still now seeing a lot of new initiatives, and I think also Phil, it's actually a new one. That means that the problem of cross-border payment is far to be solved. I mean, I think that there was a lot of push from technology because new technologies, and specifically blockchain, but let's say more easy API, ISO standards, mobile payment, all these new technology has helped in some way to streamline the process. But I always try to divide two things. There are when we speak about frictions in cross-border, I always want to highlight that there are two different kinds of frictions. One is the technology frictions, and the one is the business friction. I think that in the last years, in the last 10 years, we pretty much been able to take out the technology frictions, but still not the business frictions. And what I'm a little bit, say, from my point of view, I mean, I am a subject matter expert. I am actually working with central banks most of my time. So with, like, let's say, a more broad view, working with the World Bank, so having like a broad view on this issue. And it's I'm sometimes starting to be worried of the number of cross-border solutions that are coming out, meaning that it looks like we are so many solutions that are not really, or let's say are, yes, addressing some issues, but not the complete end-to-end. That, of course, it's a very complicated when we go with a cross-border payment. So we are, let's say, going into a more fragmentation to create more difficulties for the banks and let's say the business to choose the right solution. And maybe they need to choose more than one, because then you need also to think about the coverage, because easy to cover the big currencies. It's a little bit less to get into the emerging countries where the currency is not so traded. So in my opinion, and that probably is the reason why the BIS and the CPI started a very, very specific programs on cross-border, because I think that there is they need some kind of help to not to coordinate or to find something that will put all the effort of all the challenger FMIs or the traditional FMIs to really address end-to-end and the business issues related to cross-border payment and make something that actually benefit the end user. Because I feel myself, because I actually live in two countries, in South Africa and in Italy, and I still feel the pain to move the money from South Africa to Italy. It takes days, it's super expensive. And on that, actually, I didn't see any change in the last actually 10 years. So I think that there is still a lot to be done, and very welcome the new initiative, because actually all of these new initiatives are pushing, in any case, all the stakeholders to get together, I think, and to try to put the effort together and find a solution.
Thank you, Claudio. What about you, Phil?
When I look at it, I see that a lot of people are very much focused on the consumer side of it. It's often the one that gets most of the attention. And to that end, there tends to be a focus on payment service operators rather than FMIs in delivering that. So the payment service operators, people like Wise and Payoneer, are mainly focused on what I would call widening the customer access and offering improved user experience, much more than tackling, say, cost, transparency, or to a lesser extent, speed. But a few of them, such as M-Pesa, are also FMIs. And then separately, we've got, as is mentioned by Claudio, we've got the entry of the crypto world into this space. But for most, they've come at it as a technology approach, and they've explored disruption of the payment rails, but they've found that there's the fundamental problem of on and off ramping, which basically holds up widespread adoption. And therefore, you only find such solutions are used where there is political or economically challenged markets. And therefore, I think the key challenge, unlike, say, with domestic faster payment systems, has been involving core institutions such as central banks and correspondent banks in assembling an effective MFMI. And without further cooperation, again, as been suggested, there's going to be increasing fragmentation and a lack of solutions.
That's really interesting. So you both agree a little bit on well, not a little bit, you both agree on that there is a lack of cooperation, which perhaps is pushing everything forward to silos, like to fragmentation of the payment system, of the cross-border payment system. And that there are still, and this is something that Claudio called still business friction, but there are the old business frictions and the new ones, which could be the lack of coordination between the new challenger FMIs and what Phil said about the involvement of central banks and the correspondent bank network. That would be more or less like a wrap-up of this first one. So thank you for this answer. About the next one, cross-border payments long-lived issues revolve around their cost and speed. How are challenger FMI solving demands for faster and cheaper cross-border payments? And this is something that you both already touched a little bit. So let's start with Phil.
Yeah. I mean, there are three broad approaches that FMIs, challenger FMIs can take. The first is they can optimize the existing model, run it more efficiently. The second is they can develop and improve the existing model. And thirdly, they can throw the existing model away and try a new approach. And we've seen all three of those attempted. Both the existing large correspondents and challengers such as Wise, Revolut, Payoneer have really gone for the optimization model. To an essence, they're not really FMIs. And I also sense that we're near the limit of this approach in achieving incremental benefits. Beyond this, we then look at the fundamental problems of how do we go for cost and speed, and we can identify three principal drivers that determine those characteristics. And those drivers are messaging, settlement, and FX liquidity. And your choices that you make there drive your other cost structures. The incumbent messaging platform, SWIFT, is driving both the ISO 222 standard implementation and GPI introductions. And both of those, when fully rolled out over perhaps the next 3 to 5 years, probably sets the limit for further evolutionary improvements on the existing messaging systems. Okay. Therefore, we then look at new FMIs, and we say they're split between those attempting model development, such as RTGS Global and ourselves, Nomos Digital, and those preferring to start with a kind of a new approach, such as Finality or the crypto-led RippleNet. In my view, the transitional challenge with new models means that it will take a long time to be effective and adopted. It's just too difficult to do it quickly. And you need much more of to focus successfully in a model transition which has low transition costs in terms of effort and technology for the existing established players. So FMIs, in my view, which focus on working with the existing systems, which is correspondent banks primarily, stand the best chance of allowing the market to deliver the FSB objectives for 2027. And those that are focused specifically on settlement and liquidity offer the greatest potential.
Thank you, Phil. Claudio, you're on mute. Thank you.
Yes. I actually agree fully with what Phil was saying, and I think I mentioned it a bit earlier. And I see that I think that probably the best outcome in the let's say in the next years will be to try to make more efficient the current solution, because of the friction, as Phil was mentioning, it's the FX liquidity, the settlement. These are things that cannot really be solved with technology. The technology can help, but changing the way to do that, it's the real key to make a cross-border payment successful. Of course, I didn't mention that there are also other things like screening, anti-money laundering, KYC, that specifically are also things that probably are contributing to make the cross-border payments a little bit cumbersome. specifically in, let's say, globally. I'm not speaking about the main corridor, but that's in any case, we never think about that, but also this aspect must be taken into consideration. And also in this case, you need a coordinated approach. These are regulatory aspects that cannot really be solved by a challenger FMI, must be solved more at institutional level. What I would like to add is that there is a challenger FMI, but there is also the new model that it's not really a new model. Let's say it's to make efficient an old model that is what is also happening, and we should look closely. The domestic payment in the last 10 years became very, very efficient with the fast payment systems. There are now more than 60 fast payment systems in the world working, and more and more we see interlinking between these payment systems. And this is another push from the institutional point of view, let's say, to create cross-border rail, let's say instant payment based on cross-border rail and based on a traditional settlement, let's say, in that sense. And of course, in this case, it requires an involvement of the central bank. And that is mainly what actually in 2020, the Financial Stability Board and the G20 group decided to, let's say, in some way to take a more proactive approach on the cross-border payments, because because the things were not going, let's say, improve quick as they were expecting. On the other side, even there was another issue that the correspondent banking was starting to decrease. So specifically on the emerging countries, we are starting to take out the agreement for the correspondent banking, so creating more difficulties. And they, of course, let's say, with the project Nexus, we are trying to enable or study and propose a model where the instant payment system can be linked together on one side, and of course, suggesting the central banks to extend the availability or the opening of the RTGS hours, because that's in a cross-border, if you want to support a cross-border payment, it's crucial, and to extend the access, to extend the participation. Because if the participation are still only to banks, it will prevent fintechs and new payment system provider to be participate in the system, and so to participate to the interlinking and to make the cross-border more efficient.
Thank you, Claudio and Phil. I'm going to wrap up a little bit. Some of the things that you just said. Technology by itself won't solve the problems. We need some coordination from market participants and the authorities. And a couple of things that I would like to highlight very precisely from what Claudio just said is that fast payment systems could be linked to make cross-border payments easier, faster, perhaps, for sure. And also extending some of the RTGS hours and the access to the RTGS systems could also help a lot to make the cross-border payment systems work better because of fintechs, big techs, and so on and so forth. So that's what I would like to wrap up from this answer. To the next one, cross-border payments have been a banking-centered industry, and that has a lot to do with what Claudio said about the access to the RTGS as well. To what extent are challenger FMIs pushing for a debanking of the cross-border payment industry? And what will be the role of correspondent banks and central banks in this process? So let's start with Claudio.
I think that, in some way, a lot of initiative of challenger FMI started to, as I mentioned, to try a technology disruption that was taking out the banking sector from the equation, specifically using crypto technology or DLT and crypto. But I think the story has told us that it's not really possible. You need to cooperate. Yes, you can create a new way to make cross-border, to be able to make more efficient let's say the availability of forex liquidity. But at the end of the day, you are managing funds, and there are also solutions that try to also use digital currencies to, let's say, to in some way to overcome the cross-border issues. But also then you get into the problem of the digital currency volatility, that it's actually very difficult to manage lately, and so it's not really a solution that can be brought in the current market. So yes, the DLT as a technology, I believe it has a huge potential to make things easier, but then you still have to cooperate with the banking system and actually with the central banks to be able to actually access to the forex liquidity and settlement facilities that you actually, in any case, you need to have.
Very interesting, Claudio. Phil?
I think it's fair to say that payments have been bank-centric for about 150 years, but they weren't always so. And the current system is one where we use credit issuing institutions running deferred settlement models, which clearly introduces systemic risks, particularly if there are liquidity crises, as we have had. And the nature of those risks, as the market becomes increasingly complicated, may not be visible to regulators in sufficient detail in a timely manner. So the existing model is not a good one to stay with, but that does not mean that debanking is the answer. In my view, from an operational perspective, debanking is neither especially desirable nor achievable. However, debanking from a risk perspective is essential. I do not believe that cryptos or DLT can have any viable contribution to a solution, because as we have said earlier on, tech is not the problem. What I believe instead is that it's essential that we have cooperation with central and correspondent banks. And I cannot see that FMIs can make progress without their cooperation to achieve the FSB objectives. It's just not practical. Okay, so I would say it's the only viable path is cooperation with both correspondents and central banks, the large ones, to create an effective system. A lot of the time we're focusing on specific user needs. I keep hearing about remittances or retail, but these are a very small part of the payment system, right? Retail plus remittances is less than 3% of the overall cross-border payment system. We have to focus on the other 97% as much and recognize that it has real practical problems. So we want a solution that doesn't just solve for what I would call the cross-border payments, but from the problems that arise out of changes to correspondent banking, which is, for example, transparency of liquidity provisioning and foreign holdings of financial holdings of currencies. At the moment, there's no transparency on that. In the US, they have a 30-day reporting by paper. If you've got your currency movement, you've got to know your data a bit faster than that. So there's more to it than just the cross-border payments when we seek to find solutions. Thank you.
That's very interesting, Phil and Claudio, because there's a word that has been mentioned several times and that I didn't expect to arise in this conversation that much, which is cooperation. because normally what you have seen in the FMI cross-border industry is that the solution will come from technology. But now I'm seeing that technology obviously makes a good contribution to solving certain problems, but perhaps without cooperation, technology is just too limited to try to solve these things. And I loved one of your answers in the sense that cryptos and DLT, perhaps they can address some issues, but they're not solving anything at all. And that's one of the questions that we were having from the audience. So that's one we can cross already out, which was if cryptos are a solution to the long-lived problems of the cross-border payments. So we can say safely that they're not. I agree with that on that with you too. That there are some other things that should we take care of first, or at least simultaneously to address the main problems. So to the next question, it's also related to something that we have already discussed. It is about how challenger FMIs could be creating silos in the cross-border payment industry. So this means how the interoperability between new and legacy cross-border payment services built on SWIFT, CLS, and the correspondent banking network are guaranteed. How to achieve that interoperability at the end. Phil.
Well, there's two basic outcomes. One is you have low interoperability or you have high interoperability. The obvious answer is that if you have high cooperation, then you get high interoperability. So then the question is, who needs to cooperate most? And the answer is, of course, those that have the existing relationships and flows. So the role of the larger correspondent banks is absolutely essential in delivering interoperability. They have the connectivity, which is both technical connectivity and contractual relationship connectivity, with thousands of endpoints, respondent banks, PSPs, whatever. And therefore, they are it. The decisions they make will ultimately determine interoperability being highly dispersed or highly close. And I think that the core is about minimizing the change at the connectivity layer whilst replacing or changing out the central infrastructure. And that would essentially ease the adoption process, and it's the only way I believe you can achieve the FSB targets. Okay.
Thank you, Phil. Claudio.
Yeah, I would love to add to what I always agree with Phil. I don't know, but what he said. But anyway, I just want to add maybe a few other thoughts because I think that I was mentioning before there is a lot of initiative of interconnecting the domestic payment system, and so I think that the capability of also for the national payment system to speak directly between them, and we have, of course, many will also enhance the interoperability between the different systems. About the challenger FMI, yeah, it's as I said, we have a lot of fragmentation, so I can't say how the interoperability will happen. I think probably yes, if you always feel that the correspondent bank will probably is the best places to guarantee this interoperability within actually very different systems. If they, of course, the correspondent banking would like to do that, because of that's another thing. If this is the role that they would like to play, I think that I want to add something. Maybe we will also mention it later. As I mentioned before, that there is the BIS with the Project Nexus that is trying to, in some way, to put some kind of try to pilot global interoperability between instant payment systems. That I think is interesting, but there are a lot of initiatives that so far we didn't mention about the central bank digital currency. That is, of course, a different model, but a lot of experiences in central bank digital currency are actually focused on cross-border. And they see the direct involvement of the central banks. I mentioned again, there is the Nexus is one of the BIS Innovation Hub initiative, and we have the other, this Bridge, that is another initiative that is aiming to bring a central bank, cross-border central bank digital currency platform to enable to actually pay, that it's an alternative way to do cross-border payments, that it's not based on the commercial bank money, but based on central bank money, that it's actually a different model. That I see that have a very good potential, and actually sees the central bank step in this kind of market. That I see also a reaction to the fact that the cross-border efficiency is still not good, or is still not as expected. I see that there is a question that maybe is related, is the central bank liquidity bridge. Yes, I think that can solve issues of cross-border payment, yes, and specifically where we see this interconnection of domestic payments. A central bank liquidity bridge actually helps to connect the two domestic payments and provide the liquidity necessary to run the cross-border payment based on this rail. So in my opinion, yes, can solve not all the issues, but the liquidity issues, yes.
Perhaps I can add a little something to that, Claudio, which is that when we're talking about cross-border payments, we do have to be thinking about, how do CBDCs fit into that equation? How do we ensure that there isn't a massive technology transition that imposes costs? And at the moment, a lot of the initiatives in the cross-border areas around CBDCs have been about trialing bilateral settlement mechanisms. And the feedback that I've picked up most is that bilateral settlement is not the answer, because you'll end up with 14,000 different bilateral settlement agreements. And that just makes for chaos in setting standards. And so you're going to need to move to a solution which incorporates a multilateral facility. And you're going to have to ensure that there are very few participants in providing that. You can't have thousands.
That's great. I have something to add. And first, like a question: are there any incentives for large interconnected correspondent banks to facilitate the interconnectedness? I mean, the interoperability. That's a big question. I mean, are there the incentives there? And like a follow-up question to this one is: if there is no incentives for commercial banks, I mean, for the private sector to do this interconnectedness or this interoperability, are the central banks, or should the central banks step in to provide this as a public service, as in any market inefficiency type of thing? And also what Phil said in your second intervention is, if there is no bilateral settlement facilities, could central banks provide this type of multilateral settlements if the market is not willing to provide them? Very briefly, can you say something about this?
Okay, yes, I start. Yeah, okay. So if the correspondent banking are willing to have this role, that was my question. I'm not sure, because of course I think they prefer to, in some way, to drive his own efficiency path, or to choose and not. I mean, I don't think they will be interested as a service to make things interoperable, unless there is maybe a major market to do that. So they want to interlink. I believe that the central banks are trying to, in some way, to create this interoperability. And with also new models. And Phil was, I know that it's the central bank digital currency is still in test, let's say in trial, but is moving fast. And the BIS initiative and bridge is a multilateral bridge, actually. So it's a multilateral bridge between central banks, as 5 central banks, and actually is going to go live next year. So the things are moving very fast on that side. And so I just highlighted to to keep an eye on that because they took years and years and years of trials to move, but things are now getting faster and faster.
Thank you, Claudio.
Perhaps I can comment on the correspondence. I mean, my view is the only reason the correspondents would get involved is if it's got a cost benefit for them. You know, it's got to be profit. It's not because they want to cooperate. So the answer is very simple. How much money can they make by changing the model and acting as a kind of aggregator of the connectivity layer? And the answer is, I think they can make a lot of money. I'm just trying to work with them to evaluate how much. But the answer to that is, if it is a provable business case, then they will get involved.
That's interesting. Thank you, Phil and Claudio. Let's go to the next one, which is going to the risk part of the cross-border payment ecosystem. Could the interconnectedness between challenger FMIs and the legacy FMIs threaten the stability of the global payment system? Phil?
Well, I'm not a regulator, so overseeing risk. So regulators are best make the judgment on that. But I would say that challenger FMIs are a low risk when it comes to stability of the global payment system. I don't think they add incremental risk to the system. However, as we discussed earlier, fragmentation is a serious risk, and other factors such as sanctions enforcement may be severely impacted if there is that fragmentation. And therefore, I think if you have to look at the totality of desired outcomes, of which stability is just one, I think central banks really do have to engage. I don't think that standing still is an option.
Yeah,
thank you, Phil.
Fully agree. Yeah, I fully agree. I just want to add that the FMI, the challenge FMI itself, actually I agree that not introducing risk. I'm more worried about if some challenge FMI is interlinking to system, so potentially transmit the risk from one system they are connect to the other system they are connect. So not being a risk itself, but transmitting the risk from one part to the other. And that I agree. And so the central bank has to, of course, pay attention what is going on. They are the regulator. They need to protect the liquidity. They need to protect the market, and they need to see all this evolution is going where it's going, and if needed to regulate it, but in a way that keeps let's say keep the potential of the innovation. So regulating, thinking that they not should, in any case, as much as possible, enable challenger FMI to bring innovation. So not regulating, trying to cut, to cut the wings of this FMI, but being risk conscious, but also being knowledgeable that these FMI, challenger FMI, are bringing value.
Thank you, Claudio and Phil. And I'm going now to how do FMIs, traditional FMIs, manage risks? And it has to do a lot with the BIS IOSCO principles for financial market infrastructures. So one interesting question is, are challenger FMIs ready to observe or obey these principles so we can feel like more comfortable with the risk that they're posing to the system? Claudio.
Okay, now, I think that it's a good thing. And to be honest, it's not rocket science to follow the 24 principles. Actually, I am also working on that, assessing against PFMI principles. I think it's a good way to conduct business, being compliant to those principles. And most of them, in reality, must any FMI that wants to play in this kind of market, specifically want to offer the service, should follow. In any case, most of them, maybe not all, but all around operational risk, governance. All these things are a good way to manage mission critical systems, as FMI should be seen. Now, in some cases, so I think that it's good that FMI will follow those, because I think it's bring value saying to be compliant, because it's give also the guarantee that the processes and the way the business is conducted is sound. And the other way, of course, the central bank can, and I think in some cases is done, impose, so declare, because there is also this definition. The central bank, if the central bank declares that the company is an FMI, then it's mandatory subject to the principle. But you can be an FMI without being, let's say, officially named as an FMI by the central bank. Mm-hmm. So the central bank will definitely give and see if an operator it's actually, let's say, creating or potentially creating a risk on stability. They can declare it an FMI and ask them to be compliant to the principles.
Thank you, Claudio. Phil.
I'm not sure I can add more to that complete answer, but I would say that FMIs will generally observe these principles where central banks are supporting and enabling their business models. And if they're not, then they'll be driven by market expediency. They'll be driven by what the market opportunity is to them as to whether they should do it. If they can make a business model without having to be so rigorously defined, they will. If they can't, they won't.
That's interesting. And as Claudio mentioned at the beginning of his answer, following the principle for financial market infrastructure is not rocket science. But you know that one of the things that at the beginning of our webinar or broadcast showed is that there are solutions to do that. And FNA is one of the providers or the leading provider of this type of solutions to try to do the stress testing and the monitoring, which is perhaps the hardest part of the principle for financial market infrastructure. So that's something that it's achievable even for a small new challenger FMI, and that's something worth taking into account. So we're going to the last one, which is finally, do you think the public has started experiencing benefits from the entrance of challenger FMIs to the cross-border payment system? Are there any numbers to support this? So let's start with Phil.
Well, it's very clear that the retail market, probably in the $1,000 to $100,000 market, has definitely experienced transformation over the last 10 years. I recollect going into my bank 25 years ago and being able to buy FX cash over the counter for a 1% spread. And then about 15 years ago, you were paying 14% spreads. So the market went from being an uncompetitive space to being very rigorously competed at high pricing. And now we're back down to 45, 50 basis points for retail. So clearly, businesses such as Wise, Payoneer have optimized the existing correspondent banking model and have brought down costs for retail. Now, we don't see much of that, though, outside of the main payment corridors. So the remittance corridors have been much more resistant to those, not least because the transmission costs are a smaller component than the customer acquisition and customer management costs. And that's where a lot of the effort is being focused on. How do you reduce the customer acquisition costs? And obviously the transaction sizes are smaller. So I don't think we've had a lot of benefits in terms of cost, but we have had some in terms of speed and also in terms of access, okay, widened access. At the other end of the business, there's all the other stuff, corporate, and we've got the capital markets activities. And we've seen innovations coming out from people like Visa trying to offer competing sort of payment movement systems, which is not big necessarily on the cost side of it, but it is improving the service offering for treasury managers. And I believe MasterCard has followed on with that. But all of them still work on old fundamental infrastructure. So a lot of it is still front-end experience rather than back-end wholesale infrastructure. And I think we've still got to wait a few years yet, probably 5 to 10 years, before we really see new wholesale infrastructures, universal infrastructures for high value, low value remittances, etc., emerging into the market and having a big cost impact. And I think that cost impact will be significant across all payment values, and perhaps of the order of 40 to 60% over the baseline that we've got right now. And importantly, speed will be near instant.
Okay. Thank you, Phil. That's very interesting.
Some way to go.
Claudio.
Yeah, I will end as I started. I am, of course, unfortunately, not on the main corridors. So as nothing for me changed in the last 10 years. I'm sorry, I'm speaking about myself. So of course, I don't want to. There was a lot of more efficiency, specifically in the business area. But if you are out from the principal corridor, it's difficult to see all this efficiency. So it's good, and I mean, in Europe, everything works like fantastically. And you can actually move money even in the principal corridor very easily. But if you are out from that, you actually don't experience an improvement. Not maybe any, but very, very, very few. And that's my experience. These are the numbers that I know because I do it. But and unfortunately, not being in the main corridor, it's still a problem.
That's very interesting, Claudio and Phil. Thank you for answering this question. Now I'm going to give you like a couple of questions that come from the audience. So the first one is, how would you address fragmentation risk? And I think this is something that has to do with cooperation and coordination we have already talked about. What would it take for you to step aside for another solution? Besides I guess, besides the fragmentation, I would say. I mean, I think that the question goes to, if the system is fragmented, I mean, how would you step from one solution to another? I mean, what would make you change from one solution to the other, and to pass from one solution that you're already using to a new one which is not connected to that one? I think that's the idea of the question. What do you think? Makes sense?
Well, yeah, maybe I can try that one. The biggest cost, the biggest volume is going through respondent banks. All right, so respondent banks are the ones you need to focus on, not necessarily for pure retail payments, but for the volume of payments. So the question is, what do respondent banks do to change? Well, if they want to change, they've got to build up a new relationship with another effective equivalence to a correspondent, and that could cost them a lot of money. I think it was evaluated, it costs about $27,000 a year just to have a relationship. And then you've got your technology costs, your implementation, and it can take up to a year to get a relationship set up. So these are the kind of barriers you've got as a baseline to forming a new relationship as a respondent with another party. And therefore, I can't actually see that you're going to get, fragmentation will be slow, but it will be dispersed, right? It's more likely that people grow the number of relationships they've had, but they're still limited from, say, 2 or 3 correspondents max, maybe growing up to a third fragmented alternative. I think the answer is that what's actually getting fragmented is liquidity, right, and risk, right? So you've got inefficient, the fragmentation leads to inefficiency in capital, right? Not just in the liquidity side, but in your capital charges against the risk profile of your payments. And therefore, there will be a reluctance to permit fragmentation unless the benefits are huge. And as the existing model is not very profitable, I think McKinsey calculates the aggregate model is only 35 basis points of profit. There's not a lot of opportunity.
Thank you, Phil.
Yeah, yeah. I mean, to this. Okay, I would not. My dream is not. I would like not to see this fragmentation. So my experience is aiming to try to help and to support the coordination to have some kind of interoperability and not to force someone to decide which channel to choose, let's say, in that sense. Because otherwise, yes, or I set up many connection because I want to have many system, or I will have to choose which is the best. But it's every time. I mean, it's also a cost to reconnect to different system because they have a different business structure, different fees, different way to work, and that it's painful. And that it's where I started that I'm very worried about the fragmentation. And of course, adding what Phil was saying, the risk, the liquidity fragmentation, that of course is additional issues. And there was also a question about that the challenger FMI are introducing issues. They are not only taking out issues, but also introducing new one. Yes, I think that unfortunately the answer is yes, it's possible about that. And the other thing was another question about open banking, open finance, that maybe can be related. I don't think open banking can change anything in this kind of field, but maybe open finance, it may be a possibility if actually give you access to the Forex liquidity, a more open and transparent access to the Forex liquidity, then may help.
Thank you, Claudio and Phil. I was going to go to that open banking and open finance, but Claudio, you already addressed it, so let's leave it like that. And we have a last question that we just received, which is very interesting to me, at least, which is why is scaling for challenger FMIs in gross settlement, like RTGS Global, and I could add Finality as well, why is their scaling taking a long time? Is there any issues that prevent them from achieving a large scale fast in the cross-border payment system? That's a very interesting one.
Yeah, okay, Phil, you can go first.
I would say the challenge is connectivity, right? And if you have, let's say, there's 102,000 institutions that have addressing on SWIFT. Maybe only 3,000 to 5,000 are absolutely critical for volume, but it's still a large number of parties. Why does Finality have difficulties? Well, because it's putting up a new infrastructure and it would require everyone to move to a new infrastructure. It requires cooperation and agreements with central banks to establish the accounts. It requires all of that to be risk assessed by lots of independent third parties that are not cooperating with one another. So it's very challenging for them to get their infrastructure up and running. RTGS Global, different problem, and they're tackling it a different way. They're actually trying to build up from the bottom end. They're reliant primarily on their clients creating the scaling effect, I believe. So there's lots of different reasons, there's lots of ways of tackling it, but I do fundamentally believe that any solution has to focus on the adoption and scalability as the primary decision driver for the solution.
Thank you, Phil. We have 1 minute, Claudio.
Yeah, I mean, just want to add, sometimes it's difficult to explain how the fantastic and beautiful solutions are not scaling quick. And I think sometimes it's because it's, even for the participant of the new solution, and we saw many, because banks are actually participating to a lot of solutions. They don't, in some way, they don't want to speed the transition too fast. So what I'm saying is they are resistant to the change. So they like a new solution, but not too fast. Okay, so even if a solution is brilliant, the participant or the adopters of the solution, they don't push to go too fast to change the current model. That's what the experience. So, and unfortunately, is probably one of the issues of all the smart and fantastic solution of cross-border that we saw. That actually, even the participant, the banks, and are doesn't want to rush too fast.
That answer from Claudi also seems to apply for CBDC deployment, right?
Yeah, CB deployment has also, let's say, a lot of other think around the regulatory and technology and so on. But yes, even if I think that being driven by central bank, it has potentially can have potentially also when ready, let's say, a faster adoption.
Mm. But I think CBDCs, though, are to a great extent in the countries where they're rolling out a political maneuver rather than a payments maneuver. We're seeing political statements that these are what we want, and they're being driven by this need. And I have looked at these systems, and I am very doubtful that they have sufficiently thought through the systemic impact.
I think we'll need another hour
yeah, that is the only thing. Yeah, that is the only thing I don't agree.
Invite you to that.
That is the only thing I don't agree today.
I think I will invite you to both to the CBDC broadcast as well. So thank you for Phil and Claudia for being with us today. This is the end of the 4th FMI broadcast from FNA. So in this slide, you will find some of the events that we're having in September, like the CBDC Simulation Tech Showcase, the FMI broadcast number 5 with Tonality, Subtech broadcast number 1 with Regnology and Oliver Wyman, and CBDC broadcast number 9 with Accenture and G+D. So thank you both for being here, and I hope to see you perhaps in the CBDC broadcast in a couple of months, because I think that we can have a very interesting conversation about that. Thank you, Claudia. Thank you, Phil. Thank you all the attendants for being here with us today. Have a nice day, all of you.
Thank you.